We have a presentation today with, let me see now, Tethys Oil.
Tethys Oil, yes.
Tethys Oil, yes. Magnus Nordin, CEO of the company. My name is Christer Lind, responsible for ABG Research. So the floor is yours.
Thank you very much. Okay, ladies and gentlemen, delighted to be here to talk about Tethys. I hope we have some interesting things to talk about. We do consider ourselves an interesting investment case, although we have been around for now a good 15 years in the public environment. This is a photograph from our operations in southern Oman, where we recently conducted a seismic survey in the Rub al Khali basin, not too far away from the border of Saudi Arabia. And we have a nice oasis in the background and the Chinese-operated seismic trucks in the foreground. But let's start from the beginning. We've been around since 2004 in the public environment, and since 2010 we have produced more than 27 million barrels of oil net to Tethys, which has yielded us substantial income, and we have actually distributed more than $80 million to our shareholders since that time, and which is more than we have raised in our IPO a long time ago. And things are going quite well. We reported record production from our main license in Oman during October. We have had very good reserve replacement ratios, which is a key indicator for an oil company. I mean, obviously you produce your oil and you make your money that way, but if you are out of reserves, you cease to exist. So what you of course strive to do is to find more oil every year than you actually produce. And in 2018, we replaced 177% of our production. So we are a continued growth case, and we left 2018 with 25.4 million barrels of oil in reserves, which is almost as much as we have produced over the last 10 years. We have a number of projects ongoing, and we collected several thousand square kilometers of new 3D seismic in several blocks. And we have recently added 20% stake in Block 56, also in the southern part of Oman. We are listed on Nasdaq Stockholm, mid-cap segment, trading around 75 crowns per share. That gives us a market cap of about 2.7 billion crowns, or around $275 million. Strong balance sheet, and no long-term debt, and a net cash position as at 30th September of $71.9 million. Good liquidity, important for an investor. 240,000 shares per day, which actually gives a full turnover of the entire share stock in about 2.5 times a year. 36 million shares outstanding. Of those, Tethys owns or close to 2 million shares. As I mentioned, strong balance sheet. We have shareholders' equity of $273 million, but more importantly, we have had a strong cash position for the last couple of years, and as of 30th of June, almost $72 million worth of cash, which is actually 750 million crowns. Oof. The cash comes from our production, which has been reasonably stable, just over 4 million barrels for 2016, 17 and 18. And so far this year, we have produced 3.4 million barrels. And we're actually looking at record production for the third quarter and record production for the month of October. So we expect the full year production to be higher than it was earlier in the previous years. Revenue, very oil price dependent. So far this year, we have sold oil for about $114 million, just over 1.1 billion crowns. EBITDA, the cash flow, that's what we actually get after our costs. In 2018, we generated just over $100 million, and so far, for the first 9 months, we did just over $70 million. And as you can see, there is a strong correlation between revenue and EBITDA to the oil price. So at $70 oil last year, we netted just over 100, whereas at $50 oil the year before, we only got to 80, which is not bad. So with increased production and an average price so far this year of 74, we are looking at a very healthy cash flow generation. As I mentioned, reserves, and in particular the replacement of reserves, i.e. that you find more oil than you produce, is one of the most important key indicators for an oil company. And we have actually never found less oil than we produced since we started production in 2010. On average, we have found about 150% of production. And obviously we are keen to see what we can achieve for 2019, given that we had a very good year in 2018 with 177%. We have a very limited geographical focus when it comes to our assets. We are focused on the Sultanate of Oman, where we now have interests in 4 different licenses. One is a combined license over 2 blocks 3 and 4, where we have a 30% share. That's where we have our production, and that's where we have our reserves. We have one exploration block, block 49, that we have 100% interest. We've had the block since 2017, and after completing initial geological and geophysical studies, we conducted a seismic campaign earlier this year, where you've seen a picture from, and we are now in a position where we're getting ready to drill our first well on that block. And we have just acquired 20% in block 56, a little bit south of 3 and 4 over here, and in parallel with block 49. It's a block that we find quite interesting. We don't operate it, but we see strong potential, and in particular we see strong synergies geologically with what we've done in blocks 3 and 4. Oman in general is a very good place to be. It's very much part of the Middle Eastern oil fairway. As you can see, we have oil all the way here from southern Turkey through Iran, Iraq, Persian Gulf, Saudi Arabia, of course, the world's largest oil field here, the Khawar field, Abu Dhabi, United Emirates, and the oil continues into Oman. And our areas are here, here, and here. Oman is a friendly and efficient country. We have strong support from the oil ministry. Infrastructure is excellent, with a large pipeline capacity, and all oil field-related services are readily available. Oman produces just over 1 million barrels of oil per day, just under Norway's production. And there are similarities with Sweden. Small population, sparsely populated, and surface-wise, it's about 2/3 of Sweden. And I should mention that our combined license interest is actually close to 15% of the entire Omani landmass, which actually puts us in 2nd or 3rd place when it comes to license holders. We are about number 6, 7 when it comes to production. Just a quick reminder, it is a geological exercise we're dealing with. We want to find a set of sedimentary rocks where you have a rich organic shale, a very porous sandstone or carbonate, and then a thick, impenetrable shale on top where the oil stays. And that's what the seismic exercises are all about. You want to get a map of what it looks like underneath the surface. And as such, you send down, or you have these trucks stand on their feet and vibrate like this to create a wave that goes down into the ground. And as it's reflected from various layers of rock, you get a picture of where you could have an oil or gas trap. And that's really the starting point for all the oil we are looking for and that we also have produced. All our oil fields look schematically like this, and then they are different size and different composition. But this is the seismic mark that we are looking for. Block 3 and 4 is our oldest blocks. We've had them since 2007, been in production since 2010. License is valid until 2040. 49, we signed in 2017. We've had it for just over 2 years. We have an initial 3 years to drill a first well, and then we can elect to continue, keep the block for another 3 years, or if we find something, we can turn it into a production license that would in that case be valid for up to 20 years. Block 56 has been around since 2014, and we recently acquired a 20% interest. We are looking at an exploration period that will be extended to 2023, and then we'll see if we have a commercial discovery or not. 3 and 4 shows a rather complex geology of a number of reasonably small oil fields. All the green stuff here are producing fields. This cluster here we found over the last couple of years. The Farah South field was discovered or put in production in 2010, the Shahad field in 2012. But more importantly is that we are expanding. The blue boxes here shows where we have 3D seismic coverage. And we are expanding that to cover virtually all of Block 3 and a large part of Block 4. And we have a number of potential oil fields already identified as leads and prospects that we are going to drill over the next couple of years. So for as much as we have already produced more than 7 million barrels net to Tethys, we have remaining reserves of 26 million barrels. We still have a large potential left that we will start to drill over the next couple of years. Block 49 is a earlier story. It's somewhat in the same position that Blocks 3 and 4 were when we entered them in 2007. Several wells have been drilled by previous operators. All of them had, or I should say actually most of them, had encountered oil in some fashion, but no one was sufficiently interesting to be commercial. So after having conducted a review of all previous wells, and looked at where it's most likely that oil has been generated in sufficient quantities based on the well data. We have conducted 2 seismic campaigns, one 2D and one 3D, over what we consider so far the most interesting area. And that's where we are now, have matured a prospect. So we have a potential oil field identified, and we are now in preparation to drill that in the first half of next year. If it's a discovery, we'll appraise it, get it in production as quickly as possible, and keep the license for a good 20 years. If it's not a discovery, depending on the results, we'll see if we do more work here or if we concentrate somewhere else. Block 56 is closer to the ocean and south of Blocks 3 and 4. Also a rather interesting exploration block, 11 wells drilled here, all but one have encountered oil. We are going to do some fairly interesting work more or less immediately, and over the next couple of months test 2 or 3 of these wells that have been drilled by previous operators to try and establish flows and show that they are viable petroleum systems. Several of the plays and the geology that we have here is very similar to Blocks 3 and 4, where incidentally no oil had been produced before Tethys got involved with that block in 2007, 2008 either. So we believe that we are on to 2 very interesting blocks in 49 and 56, where we can add a lot of valuable knowledge that we have acquired over the 10 years we've been working in Oman. So to sum up, we do believe that we are an interesting investment case. If you want exposure to oil price, if you want to have a good cash flow generating stock that has paid out large dividends to shareholders over the last 3-4 years, and with a strong organic growth potential from existing licenses. We believe that we can offer everything to everyone, really. Dividends, organic growth, and exposure to the oil price. And then, of course, the question is, does one want to have exposure to the oil price? Is it going to, are we going to continue to use oil? Will there still be consumers that will pay for oil? I mean, that's in effect the business we are in. We provide energy to consumers, and as long as there is demand, we will continue to produce oil. So let's touch on the oil price a little bit. First, and also from an investment perspective, oil prices have historically been difficult to predict, and they have fluctuated. We have a sharp drop here in 2008 with the financial crisis, and here in 2014, when there was a production war between Saudi Arabia and American shale, which stabilized with a truce in 2016, and we've since then been hovering plus minus $60 per barrel. Is this sustainable? Will prices continue? Will oil still be needed? And this is a rather important slide to explain why I do think oil will still be needed. This is the decline rate for mature oil fields. So the production we have today declines by more than 5% a year, which means just to satisfy current demand, we have to find 5% of a yearly production every year. And on top of that, since the 80s, we've had an annual growth rate of about 1.5% every single year. And that's important to remember when we discuss whether oil will be needed in the future. We talk about alternatives, and yet those alternatives have not even been able to stop oil from increasing in use, while at the same time existing fields decline by 5% a year. And if we look at the alternatives to fossil fuels, is this little green wedge down here. So it's a rather massive challenge. This includes coal and others also, but the renewable side has a long way to go until it really becomes an alternative. Today we consume 35 billion barrels each year, and that's an enormous amount of oil. That is probably not sustainable in the long run. The Johan Sverdrup field, Norway's largest discovery in 20 years, known also from Swedish company Lundin Oil, is a discovery of about 3 billion barrels. That's 10% of consumption. It covers 2 years of declining fields. So when we see this curve here, an oil price that's hovered between 50 and 80 for the last couple of years, I do think we are going to see a strong dependence of oil for the foreseeable future. And anything that we can do to substitute here is badly needed. I mean, obviously 35 billion barrels is an enormous amount of oil that we consume, and it's not a good idea to change the composition of the atmosphere. So we have a challenge here for all of society, that we as an oil company will assist as best we can. But our job here is to provide energy, oil, as long as that's needed. And our challenge is to do that in as an environmentally friendly and cost-efficient way as we can. And I believe Tethys can offer such an investment case. And I believe we will be doing that for some time to come, with expansion in Oman and continued distributing cash back to our shareholders. Thank you very much.
Thank you. An applause before the questions. That's the first time today. So you will get another one soon. Thank you very much. Before we start with the more detailed questions on you, I think we have to just look a bit higher up now and see a little bit about the geopolitical situation we have currently in the world. We know about the China-US trade war discussion currently. We also know that Iran has been an issue, and I don't think that many here have a full understanding of Oman. Is this something you should be aware of risk-wise, that it's a safe harbor in that segment of the world, or yeah?
Okay, arguably I'd say that Oman is the most stable country within the entire Middle East, North Africa region. Small population, per capita income around $15,000, and no massive youth unemployment problems or massive open unemployment in general. Oman has traditionally, foreign policy-wise, been like Sweden, neutral, the Switzerland of the Persian Gulf. Good relations with Oman, with Iran, decent relations with Saudi Arabia, very good relationships with the USA, and a constant advocate for measured and negotiated solutions to the problems of the region. Oman, together with Sweden, is highly involved in the peace discussions in Yemen between Saudi Arabia and the Houthi separatists. Oman has a strong profile with the United States and has been used both by the United States and the United Kingdom to communicate with Iran. So the country is very well plugged into the international scene and with very good relationships to the powers that matter, I would argue.
Thank you. And if you then look into your own company, we talked a little bit about block 3 and 4 that is going very well, that is conclusion. You see a lot of prospects. When it comes to production, as it is currently, how much higher do you think you can go over the coming years?
We've guided for the current year between 12 and 13,000 barrels per day. We are currently, the last month was about over 13, but year to date, I think it's around 12,700. And obviously we haven't changed our guidance, so we expect to come in somewhere in the higher end of the guidance between 12 and 13. And we haven't said anything about next year. It's dependent on next year's work program that won't be decided until later in December. So it's difficult for me to say, but given the growth potential we have, albeit that some of the older fields are in decline, we look optimistically on the future. But we should be able to be much more precise in just over a month when we could guide for 2020.
Okay. And as you said, you mentioned you have several interesting prospects in Oman and other blocks, but you have a strong cash position. I generate a lot of cash flow currently. Are there any prospects, ideas about M&A outside your own universe in Oman, or?
We have a very strong cash. We have had strong cash flows, as I show with the EBITDA being good over the last 3 years, and it's above $60 oil. We certainly make good money, and we have a strong cash position. We have a nice war chest, and we are on the lookout for other opportunities. However, with drilling coming up in 49 and with Block 56, that will also require some capital. Of course, a discovery in Block 49, we will need capital to develop that. So we are in the very fortunate position that we can drill an exploration well here on 49 without having to rely on outside sources. And if another opportunity shows up, another block or potentially in Oman or somewhere else in the Middle East, North African region, we would be prepared to strike. But given the strong position we have and the very good projects we have in arguably the most stable country in the Middle East, the bar is pretty high for taking on something else, because it will have to stand up to what we already have. And with strong growth potential there, as I say, would happily do it, but the bar is high to enter into something else.
Yeah. And two final questions here. Maybe number one is that can you mention a little bit about your capex level for next year, and on that also, how is the general environment in Oman regarding inflation in general?
Okay. Again, the capex will guide once the budget for next year has been approved, which it hasn't yet. So we will do that in January. Inflation, well, the country inflation rate is less of interest to us. I mean, what we The Omani currency is pegged to the dollar, and that's what we report in dollars. So I mean, we have all our costs paid virtually in dollars, and we have the oil price, we get paid in dollars. So whatever inflation or deflation we see on the cost side is more a function of oil price. Higher oil price tends to lead to contractors and suppliers charging more for the services. Lower oil price is the opposite. So we are not that dependent on in-country financing.
And then maybe the final, more tricky question. When we look at the data on the valuation of the company currently, you have a yield just below 10%. You have a PE ratios around 5, and you have done buybacks in the past. And have you any idea of how you could increase your value of your company, that you get a higher interest or more? In general, the energy companies are low valuation currently, but there are different quality among the companies also.
Obviously an interesting question. In general, the market is always right, as we all know. I mean, I would certainly not argue with the evaluation we have. The best way for us to show that the growth case is not a case of the past. We have increased reserves by 50% plus for the last 10 years. If we continue to do that, or if we have a sizable discovery, say in Block 49, that would speak for itself. Otherwise, I would say it's just continue to do more of the same and continue to deliver, and then I'm sure we will get the evaluation we deserve.
Yep. Thank you very much, Magnus.
Thank you.